You are listening to Keystone's Stock Talk Show, episode 263. If this is your first time listening, then thanks for stopping by. This podcast is produced every week for your enjoyment, and show notes are found at www.keystocks.com. Come back often, and feel free to add the podcast to your favorite RSS feed or on iTunes. You can also follow us on Twitter at Keystocks and on Facebook. And keep submitting your stocks via the usual social channels or at our website, keystocks.com, for our Your Stock Our Take segment. And we just might review your stock in an upcoming show and let you know if it is a buy, sell, or hold. It's great to chat with you again. I will start with a brief review of the Q3 numbers released late last week from a company that should be no stranger to our clients, Hammond Power Inc., the symbol HPS.A on the Toronto Stock Exchange, a stock which has been a buy recommendation in our Canadian small cap coverage dating back decades, has now gained over 19,000%. Hammond, which enables electrification through its broad range of dry-type transformers, power quality products, and related magnetics, reported better than expected Q2 2024 numbers last week, which boosted the stock. In our Your Stock Our Take segment, Aaron begins by answering a viewer question on CrowdStrike Holdings Inc., symbol CRWD on the NASDAQ, a cybersecurity company that specializes in endpoint security, which recently saw its share price drop after being identified as the culprit in the huge Microsoft outage. Aaron lets you know if this drop is an opportunity or not. Brett answers a viewer question on MTY Food Group, symbol MTY on the TSX, a franchisor in the quick and casual dining industry. The viewer asks if MTY is a value trap as valuations have fallen since they bought it a few years ago. Brett will let you know. Finally, Brennan put together a segment on interest rates and how they affect bank stocks, and we look forward to that. All right, let's get to the show. My co-host, Mr. Aaron Dunn, the Killer Bees, Brett and Brennan. How are you doing? You have a good weekend?
You're good.
You betcha.
Well, let's take a look at our poll for last week about the Magnificent Seven and the NASDAQ index. And they're seeing weakness after Tesla's earnings. Is big tech going to see a correction? And you got three choices there. Brett, you can tell us what those three choices are.
Yeah. So the question is, the Magnificent Seven and the NASDAQ index are seeing price weakness after Tesla earnings. Is big tech going to see a correction? We had 18% of our viewers vote for this as a blip before the continuing bull run. 67%, so the majority, say they expect a small to moderate correction. And 15% say they expect tech to fall into a bear market.
I think
that big tech, like the Magnificent Seven falling into a bear market, what that would require would be some type of overall macroeconomic decline or flattening of just technology innovation, like AI adoption and that kind of thing. Because if you look at, I'll just using Microsoft as an example, because somebody had asked me recently about the valuation. Microsoft right now is trading at about 32, 33 times next year's earnings. And that's really around where we've been buying the stock at for most of the last, I would say 3 years. Obviously, there's been some dips. Certainly with the pandemic decline or whatever. So it's say 5 years back, but most of the last 3 years we've been buying it in the low 30s range. So really the share price appreciation we've seen in Microsoft has been mostly almost completely driven by earnings growth. And Google's kind of a similar story with a little more volatility in the valuation, but really I see them as being plays on technology innovation and adoption.
Yeah, one thing that I've been seeing as well, and I know me and Brett and I had talked about it a little bit, is just the rotation to small cap from tech stock continues. I mean, this is just an article from Forbes here, basically. But they say the market rotation that began on July 9th continued with the mega cap technology stocks falling despite better profit growth and weighing in the index, while smaller companies outperformed. Small cap stocks are 11.4% higher, while the Magnificent Seven and the S&P 500 declined by 10.9% and 2.1% respectively. So I know that this is, something that's been circulating online, or at least what people have been talking about, analysts have been talking about.
Yeah, well, we've been detailing to our clients. I've given several speeches on it in the past year. The valuation gap, and it hit a low point in the fall, is the really lowest in 20-25 years between small cap and large cap. A lot of that is driven by underperformance by small cap, but primarily it's really been driven by outperformance by the mega cap stocks. So a pullback in those mega cap stocks, to me, would be healthy, and you've seen that, a slight pullback in them after a tremendous run. It'd be probably healthy to just bring them back to a little bit more to historical averages. The thing on the small cap side is earnings growth actually hasn't stopped. Like earnings growth in these small caps, when you look at the numbers, and we're actually putting something together on this, has been at or above the large cap rate. So the growth rate there continues, and the small cap valuation has flipped. Because historically, if you look back, 100 plus years, small caps have traded at a premium valuation due to their outsized growth versus larger cap companies. So if you see that flip, and you see the lower valuations you're getting in small to mid cap quality companies, and again, there's a lot of small cap mid cap crap out there that you got to avoid, but you're looking at quality earnings based companies where the opportunity is, and we've already seen that happen. We were just talking this morning. The three companies we recommended when we highlighted this gap between the valuation on the large cap and the small cap stocks, three of those companies, the laggard is up 40% right now. One of the companies is up 200%, and the other one is up about 140%. So those were cash rich businesses, growing their profitability, trading then at unrealistically low valuations, and they've capitalized on that. What was low valuations, and then the growth has kicked in for all these companies, has continued. So you've seen share price appreciation and valuation metric expansion. So that's what you want to see to get those type of gains. Now we're still seeing, we've just recommended 3 new companies in our Canadian small cap service, and they are again trading at under 10 times earnings with growth well beyond that, and priced at reasonable valuations with growth ahead of them. So we're seeing still a discrepancy between where large caps and small caps are trading, and there's an opportunity right there. Again, only in the quality names, good balance sheets with growth ahead of them, and trading at those reasonable valuations. Don't just buy XYZ small cap because you think there's a valuation gap. Make sure it's a good quality company.
And that's the thing, when you see those headlines, most of the time they'll be looking at index or ETF level inflows and outflows. And for the most part with the small caps, you're looking at the Russell 2000 for those headlines. And that's what they're relying on, is the inflow into ETFs that follow that index versus your SPYs and your QQQs and all that for the tech and the mega caps. So when we're talking about when those index fall, you can have it. Good companies like the ones we've recommended get thrown out with the bathwater type of deal. So then they're trading under, and then if they do get that revaluation on top of their growth, that's when we get those multiple 100% returns or 1,000% returns over a few years. And that's
combine
what
those two things, and the kicker, like you're saying, right? Mm-hmm. Yeah, for sure. All right, I think we can head into the show now. The first company, I'm going to share my screen here. We're going to look at Hammond Power. Had a solid week last week after company had a solid week last week after reporting better than expected Q2 numbers. So let's look at Hammond Power. Again, this should be no stranger to our clients, as it's been in coverage as a buy for a couple decades now. Hammond Power, symbol HP.S on the TSX or Toronto Stock Exchange, trades at about $109 now, $1.29 billion market cap, just under 1% dividend yield. What do? They have a history. It dates back over 100 years. They enable electrification through its broad range of dry type transformers, power quality products, and related magnetics. They offer standard and custom design products that are essential and ubiquitous in electrical distribution networks through an extensive range of end applications. The company has manufacturing plants in Canada, the US, Mexico. They just launched a new plant in Mexico, India, and they sell their products around the globe. Let's look at the stock price over the past 5 years. It's up over 1,100%. Tremendous growth here. And again, our history dates back to when this stock traded at the 60-cent level. So it's been a tremendous long-term winner for our clients. Let's look at what drove the stock price gains last week. Record sales in the quarter, 197 million, up 14.3%. Earnings from operations were up 85%, and EPS was up 77%. Additionally, there were strong gross margins in the quarter, 32.8%. Year to date, 32.3%. So Q2 gross margin was better than Q1. Adjusted EBITDA percentage is 16% of sales in the quarter. Year to date, 16.4%. So adjusted EBITDA as a percentage of sales was better in Q3. Year to date, adjusted EBITDA increased 16.7% after a weaker Q1. So Q2 highlights, more highlights here. They officially opened a new factory in Mexico and achieved record all-time shipments once again in the quarter. The U.S. market is experiencing its strongest growth through the distributor channel as Hammond continues to grow both the number of new distributors as well as sales with existing distributors. OEM manufacturing channel, which while higher year to date, decreased in the quarter. So that's of note there. The backlog, despite reaching record shipment levels, the company's backlog did increase sequentially from Q1 2024, about 1%. So let's look at the valuations after this quarter and a little bit move higher in the stock price. Trailing 12 months, 26.9. EV to EBITDA 13.6, and PE based on estimates for this year of just under 20. Given the 1,100% plus gains we have seen in the past 5 years, these numbers are not overly inflated, but one has to factor in that historically, in terms of revenue growth, the company is looking at rates of 10 to 12%. So conclusion here, just first some color. Over the past 20 months, Hammond has been adding equipment to its existing factories, coupling this with strong demand, and the company has seen consistently increasing shipping volumes. This cumulative added capacity produced, again, sales growth of 14% plus year over year in the last quarter. The bulk of the announced capital expenditures for Hammond Power this year will be spent during this year and completed in early 2025. Construction and equipment installations have been running smoothly, which enabled Hammond to open the Monterrey 3 facility in Mexico, its new facility, on time and on budget. Again, bookings were strong in the second quarter, and Hammond achieved its second highest month of new orders ever in April. New orders reverted to more normal levels, management reported in June, as standard products sales cooled in the U.S., offset by somewhat increasing sales activity at new and existing distributors. The company expects the standard product market to remain stable for the remainder of the year. However, management noted that they are still expecting to see strong activity in the custom equipment as project activity remains elevated. Now, in terms of the cooling in June, it appears to be the company's standard transformer products, which are used in commercial construction products and tend to be weighted towards general economic conditions. So the softening in construction due to higher rates is impacting part of the business, which should be expected. Okay, so Hammond Power has gained over 19,000% since our original recommendation. Q2 results bested expectations. The stock, however, at the current price, trades at close to fair value in the near term. Clients will be updated on this stock this week. All right, and that'll end my brief update on Hammond.
So it's a good example of a company, because you were just talking about with Brett about how the ideal investment scenario is when you're buying a company that's a growth stock, but also where there's room for valuation expansion. So the stock price is appreciating based on obviously the earnings growth, but also the valuation relative to earnings. Now I know with Hammond Power, I remember back when you originally recommended it, this company traded at a huge discount to the market. It was
Yeah,
like
you're
4 or
talking
5
about 4
times.
to 6 times earnings. And even
Mm-hmm.
5 years ago, when we upgraded it 4 to 5 years ago, again, it was trading in that range again, anywhere from 5 to 8 times earnings. And you've seen tremendous EPS growth in the business, obviously revenue growth as well. And you've then seen the uptick in terms of the multiple that you're seeing, expansion in the multiple. And that's how you get a stock, over 5 years that can do 1,100%, and over the long term can do tens of thousands percent. And again, you've seen that with Hammond. Now that we would expect growth to continue to the end of the decade from this business, but it's not going to be in a straight line. You're going to see this type of jagged growth, as it is historically. They are, parts of the business. The standard transformers are subject to the commercial construction market. And at some point in this decade, and you're seeing it right now, you're going to see a pullback in construction. Companies that we follow in that sector have seen weaker quarters over the last 2 to 3 periods. So that's not a surprise to me. Honestly, it's surprising that Hammond is still doing tremendously well. The custom market is clearly working well for them right now, and their growth of distributors, total distributors, is helping keep sales higher. I mean, they had a record quarter there. So, and the margins continue to be there. They did have a price increase that they introduced in the last quarter. These are all good things. But if you are looking at, say, 10% growth, at 20 times forward, and that's if they hit a number that is a little more aggressive than we might look at for that quarter. But that's the consensus right now. It's probably just fairly valued right now. Again, if everybody wants electrification, the stock can trade to higher valuations in the near term. But we want to stick to a reasonable estimate based on what has historically been a growth rate and what management is really guiding towards now, being that normalized rate of growth. The balance sheet keeps getting better, so they could make an acquisition. That's the great thing about buying good companies with good balance sheets. You factor in the normal growth environment, and then they can go out and use the balance sheet where they're creating cash. They're using it to expand now with their own facilities. So organic growth, that's great, but they could make an acquisition. They have made small acquisitions that have helped growth in the past, and you may see that again. All right, well, let's move to our Your Stock, Our Take segment. Aaron's going to look at CrowdStrike, a company which has been in the news over the past several weeks after they were identified again as the main culprit in that huge Microsoft outage that we saw. Aaron, I'm going to let you take that away.
Great. Okay, happy to do that. We're going to talk about CrowdStrike Holdings, a cybersecurity company specializing in endpoint security. Very growth-oriented company. Their primary product is CrowdStrike Falcon platform, which is a cloud-native solution using lightweight agents on endpoint devices to provide security. And this is a subscription-based model company, so high recurring revenues. CrowdStrike, the symbol is CRWD on the NASDAQ, trading at $263 today. It's a $64 billion market capitalization. So as I said, CrowdStrike has been in the news recently, and not for a good reason. On July 19th, the company released a content update for Windows, which contained a defect, and over 8.5 million computers were impacted. So this is called one of the worst cyber incidents in history. Obviously, this has had a very negative impact on the company's share price, which otherwise had been trending quite strongly for the year. But since this incident occurred, the stock price is down in the double digits, down about 30% over the last couple of weeks here. So the question is, we have a cybersecurity company. Anybody who's heard me talk about the cybersecurity industry knows how great I think just the industry fundamentals are from an investment perspective. I consider cybersecurity an essential industry. And as society continues to digitize, as we adopt more AI, as more data goes online, this opens us up to cyber attacks. So it's really an industry that companies have to continue to invest in to stay ahead of the curve. But what does this mean for CrowdStrike? Stock price is down 30%. Does this mean that the company represents an attractive investment opportunity at this point in time? So I just want to take a little look at the history of CrowdStrike. So the company started trading publicly in 2017. And since then, it has been an absolute juggernaut of a revenue growth story. So every year, substantial revenue growth. And over the trailing 12 months, they've reported 3.2 billion in revenues, and this is compared to only 53 million in revenues in 2017. So we've seen absolutely massive revenue growth and market share gains over this period of time. This is largely supported share price gains as well over this period. The issue that I've had with the company, and I've been following CrowdStrike for several years, but the issue that I've always had with them is just profitability. So if we look historically, this company, although it's been generating a lot of revenue growth, has also been losing a lot of money on the bottom line, pretty much serially unprofitable for most of its time as a public company. Now, we are just starting to see it transition into reported GAAP profitability with 37 cents reported last year, 55 cents on a trailing 12-month basis. But remember, this is a $263 share price. So if we were to work out a valuation here based on GAAP earnings, you'd be looking at a valuation in the range of 500 times. Now, when we look at free cash flow, the picture improves somewhat. They have been generating strong free cash flow recently, and that free cash flow has been growing over the past several years here, basically since 2020, 452 in free cash flow per share over the trailing 12-month period. So looking at recent financial results, the last quarter that was out was the first quarter of fiscal 2025. Total revenue up 33%. Subscription revenue up 34%. Very strong margins. So subscription gross margin was 78%, which was consistent with the previous year. This is for GAAP. For non-GAAP, 80%, also consistent with the previous year. So very high margin business. And as I said, starting to get into profitability here just recently on a GAAP basis. So GAAP earnings 17 cents compared to no earnings last year. Non-GAAP or adjusted earnings of 93 cents compared to 57 cents in the first quarter of fiscal 2024. And then cash flow, they generated net cash flow of 383 million compared to 300 million in the same quarter last year, and free cash flow of 322 compared to 227. So looking at this on a cash flow basis, it certainly is a lot more attractive relative to if you're looking at it on a GAAP earnings basis. The company has put out guidance, so they're looking for revenue in the range of about $4 billion. That would be 30% growth compared to fiscal 2024. A non-GAAP earnings per share in the range of $4, again, about 29% growth compared to last year. So this gives the company a valuation based on their guidance, non-GAAP guidance. Again, this is not reported earnings. This is non-GAAP adjusted earnings, but 65 times. So definitely a premium to the market, definitely a high price company, but we can also see why when we look at the cash flow generation and the revenue growth. This is your quintessential growth stock in a strong industry. So in terms of future growth drivers, there's obviously just growth in the cybersecurity or information security market. I've already talked a little bit about the trends. There's the digitization, the increased threat of cyber attack. This company has been also increasing its market share and expanding more into cloud security. They noted ongoing investments in areas like identity protection, data protection, next-gen security. So coming out with new products and upgrading their existing. And then, of course, like everybody, emphasis on AI-driven solutions and capabilities. So our take on CrowdStrike right now, obviously, it's a very strong player in the cybersecurity industry, which is attractive, high growth company, increasing its market share. starting to get into GAAP-based profitability, but free cash flow generation has been strong and is improving. Now, the sticking point for us right now is valuation. If we were to look at the company on a trailing basis, it'd be trading at about 90 times earnings. And these are non-GAAP earnings, so these are adjusted. Now, looking forward, you're looking at about 65 times earnings. So still a premium, but starting to get into that range. Now, we would never expect a company like CrowdStrike to be cheap, but certainly once it gets into the 40 to 50 times, it starts to look a lot more interesting to us. But it's not cheap, even with the 30% decline. Now, in terms of the cybersecurity, the data breach incident, I think that creates uncertainties in the near term. I don't think it's going to impact the long-term growth profile of the company. These things happen. Companies have data breaches. They make mistakes. As long as this isn't repeated in the near term, I think that they have the opportunity to build up confidence, customer confidence again, and will likely continue to do that. But our take is that we're going to continue to monitor the company. We're going to look for a more attractive entry point, and essentially take it from there. But fundamentally, certainly a strong business and still poised for growth in the future.
Yeah, good summary. The multiple right now is higher, but did we see the multiple off free cash flow? Do you know the range there?
So the multiple of free cash
Sorry to
flow is still going
put
to
you
be
on the
around the
spot.
60 times.
Yeah. Okay.
Yeah.
All right. Well,
And just to say, free cash flow is going to reflect the adjusted earnings, and the biggest adjustment for these technology companies to get from reported to non-GAAP earnings is going to be share-based compensation. So you're paying your employees in the form of shares, not cash. So that is essentially adjusted out of earnings. Now, this is a whole other segment in terms of debating whether or not these should be adjusted out, or whether or not they should be considered. Our view is that we look at the reported earnings, the non-GAAP earnings, the free cash flow. You're not looking at any one in isolation. You're essentially looking at them all together. But regardless, certainly it's a premium valued company, for good reason, of course, because it's in an attractive industry and it's growing.
yeah. And we'll continue to monitor CrowdStrike going forward and see if there are any repercussions. I mean, I did see the flip side of people saying the fact that that it was such an impactful outage. It shows how important they are to global tech and to the security industry. Of course, they can't have too many more snafus like this, or it really can affect the business going forward. If it's a one-off, potentially it provides a buying opportunity. I'd love to see it cheaper, but there is tremendous growth there, and it's a high-quality business. All right, let's move on. I think we're going to go to Brett, right? And you're going to look at MTY.
Yep, that we are. So we're going to look through MTY Food Group, symbol MTY on the TSX. It is a franchisor in the quick and casual dining industry. The company operates under the brands, a wide variety of brands, I should say, including Papa Murphy's, Dagwood's, Cold Stone Creamery, Sushi Shop, South Street Burger, Van Hoot, Thai Express, Ben and Florentine, Mucho Burrito, West Coast Pretzels, Jugo Juice, among many, many others. They have a whole page for it. And this is really because they acquire these brands, they acquire small brands and hope to build them over time. Altogether, the company has 7,107 locations in its operations, of which 6,885 of those are franchised. So they acquire brands and then they do a franchise model. And the viewer who brought this question asked if MTY is a value trap, as the valuations have fallen since they bought it a few years ago. The stock is trading at $45.40 after falling 18% year to date with a market cap of $1.09 billion, and it has a dividend yield of 2.5% at this time. So let's look at the last quarter, fiscal Q2 2024, ending May 31st, 2024. The system sales were down slightly by 1% to $1.46 billion, with a slight decrease related to a weaker Canadian market, propped up by a slightly stronger American market. Locations were materially the same at 7,107 compared to 7,124 in the prior year, as you especially franchises that open and close various amounts quarter to quarter. In reality, it was flat. As the locations and system sales were effectively flat, you can generally expect flat financials following those two values. The only way that really changes if there's an increase on per store revenue, which when you're looking at aggregate numbers like this, normally it isn't too substantial. You might see it move up or down a few percent. But revenue came in at $304 million compared to $305 million. Normalized adjusted EBITDA came at $74 million compared to $75. Net income fell to $27.3 million from $30.4 million. But that change was largely due to foreign exchange loss of $3.4 compared to a gain of $300,000 in the prior year. So really, it's once again flat once you're accounting for that. EPS came in at $1.13 compared to $1.24. Cash flow before working capital changes came in at $73 million compared to $75 million. So overall, a materially flat year over year across the board, and no really changes that are substantial, normal fluctuations when you would expect them to be flat. Shifting to the balance sheet, as the company is a brand acquirer and the restaurant, and it is in the restaurant industry, it's no surprise that it's in a net debt position. It's across the industry. That's something you should expect. If it was net cash, that'd be surprising more than anything. The company holds cash of $52 million, $733 million in floating rate debt, and $512 million in leases, resulting in a net debt position of just under $1.2 billion. This puts the leverage ratio at 4.5 times when including the leases, or 2.5 times without the leases. Given that leases primarily relate to the corporate stores, it is expected to have a large lease balance impacting that leverage. So while it's not low by any means, it's not outlandish leverage either when you see that either 2.5 or 4.5 times, depending if you include leases. It's within normalcy for a company of this structure and within the industry. However, that does mean the company is sensitive to interest rates. Since its long-term debt is floating as well as leases, when they are renewed over time, they can be subject to higher rates when interest rates are higher compared to when they are initialized. However, now that we have seen Canadian policy rates start to drop and the American rates are expected to fall, the company will actually benefit from the rates now coming down after shooting up over the past couple of years. We've already seen 50 basis points come off the Canadian, and we're looking likely 1 to 3 cuts, depending on your analyst expectations for the American by the end of the year. Now, flipping to the dividend, the company currently pays a quarterly dividend of 28 cents or $1.12 annualized, resulting in a yield of 2.5% at this time. The company has been a pretty consistent dividend grower, barring the suspension of the dividend during COVID, which that's true for many companies across the industry as well as outside the industry. That's something which I would more or less write off as them not paying a dividend during that time, and wouldn't take into a substantial consideration going forward. And it really was at the time good management of their cash flows when they didn't really know and no one really knew at the time. The current dividend payout ratio as a percentage of free cash flow after leases is roughly 21%, which is maintainable and actually does have room to continue to grow. However, the company is at its core is an M&A company, so I wouldn't expect a massive yield to ever occur at the market price. But with the growth of it, your effective yield could build nicely over time. If you are looking to hold for 5 or 10 years, you can see it's over double from a prior decade. And if they're able to continue at this rate, you can actually get a nice effective yield if you were to buy now and hold for a decade. Now on to valuation. The valuation has dropped over time at an EV/EBITDA, I should say adjusted EV/EBITDA of 9 times and a PE of 11 times. Trailing, both ratios are quite cheap. However, I would attribute this to the lack of growth over the past year, whereas the company was previously priced to growth. It's really come off of that. I have a chart up on screen of the EV/EBITDA over time, and you can see it generally ranges in that low to single mid digits over the past decade, except for the valuation during COVID as the financials plummeted, which we'll really ignore for this. So compared to the historic valuations, it is relatively cheap when you're looking at 8 to 9 times, which is what it's been trading at for the past few months. Wrapping up, the company does have some headwinds as consumer demand is weak in Canada, and it's not the same level of strength as we saw a couple of years ago in the States. And of course, there's that constant flip-flop, though. The US, the consumer demand is going away, and then the next month when some new macroeconomic data comes out, it's booming again, it's strong, it's way better than people expected. We've really seen that flip-flop in the US. So where that lands could really actually impact the company and the industry as a whole, as the company has really been negatively impacted by interest rates as well, which if they do fall and the economies of both Canada and the US don't fall apart, it could actually be a catalyst for the company to get its revaluation back closer to its historic levels, as interest expense wouldn't really weigh on the growth and they can reinvest a bit more and they don't really have that interest rate burden on their back. But to get back to that true mid-teens valuation on EBITDA, the company needs to return to growth. They can't have these flat year over years. You're not going to value a company highly when it is not growing, either top to bottom line. Like I was going through with the financials, effectively everything was flat within normal variations quarter to quarter. If you were expecting flat going forward, there wasn't any big deviations which aren't accountable to accounting calculations or anything like that. So they need to grow to get that premium valuation compared to this discount valuation, which they're trading at the time, whether it's through organic or continuing their acquisition strategy, which is what I would expect going forward. So answering the question of whether MTY is a value trap, I would say it's not, but there is a bit higher risk compared to what there was previously, as you are seeing that flat line of growth. You're not seeing it grow year after year like you were prior to COVID or just the last couple of years. But it is still profitable, and it has largely suffered due to macroeconomic factors. When you are looking at those value trap companies, a lot of times they'll have a high dividend yield, they're paying down, and their payout ratio is quite high. They're not growing, they're in a declining business, and it's really structural to the business, not just a 1 or 2 year macroeconomic weakness. And that's really what you're seeing when there's a value trap, is something structural to the business or the industry or a combination. So that's why I wouldn't really call it a value trap. I wouldn't be jumping over to everything to purchase it at this time, but it's not overly expensive either. I'd say maybe slight discount or fair value in that range, depending on your outlook for growth.
Yeah, I think, yeah, I wouldn't call it a value trap. I mean, they have a history, this management team of growing at a well above average rate. I think it is macro that it's affecting them. The market just wants to see some kind of impetus for growth over the next 2 to 3 years. But I mean, if you look back 10 years, they did 111 million in revenues back to 2014. Trailing 12 months is 1.16 billion. Tremendous growth in revenues, and there has been growth in profitability over that time. It's flatlined over the past year, and I think that is why you see a lower multiple than historic. And the leverage is higher, so it's not unmanageable. But you need to see some way of this company growing. It's not a ton they see organically, so you need growth by acquisition. So the market's likely looking for how they're going to fund their next acquisition. How do they do that? The law of larger numbers comes into effect here too. They can't just make a 2-3 store acquisition. It has to be more significant for it to move the needle. So that's probably factoring into what's going on as well. They have shown to be good executors over the long term. We would wait until there is some execution and we see a 3-year plot ahead of them of growth. It's an interesting company, but right now the macro isn't in their favor, and how are they going to fund the growth? Lower interest rates might help that as well too. So
Yeah, and I would say the last really factor, which would be worth highlighting for why they receive a lower valuation, their brands just don't have that same staying power what's accumulated to some of the other fast food businesses. So you're not going to get a premium multiple because their brands haven't had that historic lasting value, and it's not a one brand name either, like a McDonald's or something where they just have such a staying power. And those brands demand a premium valuation by the market, and you just don't have that here.
Part of they own a food court. If you go into the mall, like 50% of the tiny little stores in there are food, quick service restaurants in there. Half the time they'll own it. But malls, not as active as we saw. Obviously, during the pandemic period, that was a very difficult period for this company. Probably the pandemic doesn't hit this company, maybe is on a different trajectory right now, but they were playing defense, obviously, during that huge. I mean, you had them owning 50% of mall traffic in the food court, and nobody was at a mall for a significant period of time. That hurts, right? So we'll continue to monitor, because we believe the management team there executes well, but they need growth.
Yeah, and I think organic is what investors are looking for too, right? Like if you're just making acquisitions and growing from that, you're considered a roll-up story, which doesn't really get the same valuation as opposed to your existing businesses have a strong organic growth just on their own, plus you're adding to that, that's a much more attractive profile, and that's what's going to get you a better valuation.
That would be the ideal mix.
Yeah, like when I did an update just for clients highlighting the business back in March of 2023, I remember in that report just talking about, I think they said like organic year over year for the quarter was like 4%. But even at that time, they were placing in pricing increases. So they didn't even break it out really between, price increases versus like volume. So, 4%, it's not that much. And I mean, again, I don't know what it is right now, but again, that's something to keep in mind, especially when a company is, putting in pricing increases, because how long, is the runway for growth from, price increases?
All right. Well, let's move to our final segment. Brennan, you're going to talk about interest rates and how they affect banks.
Yes, sir. So yeah, we actually got a question last Wednesday in our Canadian income stock chat with clients, and the individual asked, as interest rates continue to fall, what impact will this have on bank earnings? And essentially, just considering the 25 basis point decrease in the Bank of Canada's policy interest rate to 4.5% last week. I thought that it would be a good topic to cover on the podcast, and it is a question we get quite a bit. But first, I must say, effects of interest rate changes on bank profits do vary significantly by institution and time. So just keep this in mind, that I am just going to be going over some general themes and make a bit of a conclusion at the end. So looking at when interest rates rise, generally, this increases profitability across the banking sector due to rising interest rates will increase a bank's net interest margin as they take advantage of the greater spread between the interest they pay to their customers and the profits that they earn by investing, as the bank's cost of doing business are generally less affected. As well, higher interest rates are normally a sign of a booming economy, meaning demand for loans to businesses and consumers should be high. But it is somewhat of a double-edged sword, as if rates go too high, this could discourage borrowers, decreasing growth, and lead to larger credit losses, which can impact profitability. And I placed in an example of TD Bank's net interest margin over the past 11 quarters. If you're watching on YouTube, you can see this up on the screen. And the Bank of Canada began increasing its policy rate in March of 2022. And as such, we saw TD's net interest margin expand from about 1.57% as at January 31st of 2022 to about 1.82% by January 31st of 2023, when rates were then around 4.25%. So you can see the increase there that the bank had experienced. Now, when interest rates decline, generally this decreases profitability across the banking sector as the U.S. Fed and Bank of Canada lower interest rates. They encourage consumers to borrow more money to spur the economy, which is good for growth. But declining interest rates will decrease a bank's net interest margin as they earn less on short-term loans, meaning the spread between loans and the interest they pay customers shrinks. As well, lower cost of funding can lead to increased competition for deposits among customers looking for greater returns from their cash holdings. And as you can see here up on the screen, this is a direct quote from TD's Q2 2024 conference call, where they say, as we look forward to Q3 of 2024, while many factors can impact margins, we expect lower net interest margin from downward pressure due to competitive market dynamics. Now, another thing to keep an eye on is that the yield curve has been inverted for quite some time, meaning that interest earned on short-term bonds is higher than long-term bonds. And as an example, we actually have a bank under coverage that isn't a typical bank like the big banks in Canada, but it's currently experiencing some net interest margin pressure given the inverted yield curve, as its loans are longer term at lower rates than compared to its deposits, which are shorter term at higher rates. But as the yield curve normalizes, we should also see net interest margin have somewhat of a benefit there. Now, to conclude, overall, results indicate that changes in interest rates have a strong influence on banking profitability, but their precise impact is quite complex. Just looking back at TD's quote in their Q2 2024 results, indicating that many factors can impact margins. So, there's many things at play here. Generally, though, rising interest rates will, in theory, increase net interest margin, but elevated rates can lead to less growth and lead to larger credit losses, which offsets those gains. Now, when we're dealing with falling interest rates, this, in theory, will decline net interest margin, but may encourage more borrowing, propelling growth, and lead to lower credit losses. And lower cost of funding may also lead to more competition for high interest deposits, which will also decline a bank's net interest margin. Now, looking at how a specific bank will be impacted really comes down to analyzing their operations, including its loan portfolio, deposits, and how they are invested into capital markets, as lower interest rates may decrease their net interest margin, but these lower rates are generally positive for banks' capital markets division or wealth management. So the bottom line, though, is that studies really demonstrate that lower interest rates result in lower net interest margins. However, their negative effects are offset by increased fee revenue and decreased loss provisions. So really how much that offset is really depends on the institution itself. So it's quite dynamic, the things at play here. But these are just some general things that you can kind of take away when looking. Usually if we do see an interest rate increase, usually banks will lead based on that. Just their stocks, bank stocks. But yeah, that's my piece. And maybe the guys have some questions or critiques.
It was a good overview. As you said, though, it's a very complicated thing to really address. And one of the things that complicates it more is in the Canadian banking sector, and particularly all the big banks have really expanded outside of their core banking business. So we think of banks, they take deposits, they make loans, that's their core business. But, now insurance, wealth management, capital markets are also significant contributors to earnings as well. They have different sensitivities. So it's not a simple question to answer, but I think you did a good job of answering for core banking. Certainly.
Yeah. Thank you.
Excellent. Well, I think that's going to close out our show for this week. Keep your questions coming in for our Your Stock, Our Take segment, and we'll endeavor to answer those. If you're watching us right now on YouTube, smash that subscribe button. If you're viewing this or you're listening to this wherever you consume your podcasts, continue to rate and review us. As always, we ask for positive reviews. Again, I'd like to wish you profitable investing. Thank you.
Thanks, everyone.
Thank you, everyone.
Thank you.